Can a company forged in the incredibly volatile world of Bitcoin mining actually transform itself into a stable, high-margin player in the exploding AI revolution? Or is this massive, high-stakes gamble a direct road to ruin?
Yeah, that's the question, isn't it?
We've done a deep dive into the fascinating and often contradictory story of Bitfarms, and what we found suggests it's a high-risk, high-reward bet with an incredibly wide range of potential outcomes that you might not expect. Welcome to the deep dive. Today we're dissecting a stack of sources on Bitfarms Ltd, ticker symbol BITF.
Yep, BITF.
We're looking at it as of today, July 17, 2025, with its NASDAQ Q share price at $1.08.
Right, and our mission here is clear. We want to empower you with the key insights into Bitfarms' business model, its management effectiveness, its financial health, and ultimately its intrinsic value.
Got it.
We're cutting through the noise with a special focus on the recent, truly transformative strategic shift.
Okay, we've structured this deep dive into two main parts for you. First, we're going to lay the groundwork, exploring the business itself, its leadership, and its financials.
Chapters 1 through 3.
Right, chapters 1 through 3. Then we'll shift gears in the second part to really dig into market sentiment, who owns the company, and the major risks involved, culminating in our overall conclusion.
That's chapters 4 through 7.
Exactly, chapters 4 through 7. Okay, let's unpack this. Chapter 1, business analysis, from digital gold to digital infrastructure. So let's kick things off at the very beginning. This company, Bitfarms, has a pretty wild history rooted in crypto, right?
Oh, yeah.
But our sources clearly show they're in the middle of a massive pivot. What was their core business, and what exactly are they trying to become now?
Well, historically, Bitfarms was almost entirely focused on Bitcoin mining,
Okay.
earning revenue from block rewards and transaction fees. You can imagine how volatile that model is.
Totally. Tied to Bitcoin's price swings.
Exactly. Intrinsically tied to Bitcoin's price and the ever-increasing network difficulty. But now, they're explicitly trying to reduce dependency on BTC price volatility.
Right.
They're redefining themselves as a global, vertically integrated company that builds and manages data center infrastructure for Bitcoin mining and HPC AI.
Okay, so both now, mining and AI infrastructure.
Correct. This is a calculated hedge against those Bitcoin halving events.
Which slash minor margins.
Precisely. They cut minor margins significantly.
That sounds like a fundamental shift, almost a complete change in identity.
Yeah.
What are the actual services they're offering now, both the legacy stuff and these new emerging ones?
So their legacy service is straightforward Bitcoin mining, essentially providing computational power or hash rate by deploying specialized ASICs to secure the blockchain, and they get compensated in Bitcoin.
Standard mining operation.
Pretty much.
Yeah.
The emerging service, HPC AI infrastructure, is completely different.
Okay.
Here, they're leasing their physical data center infrastructure, the buildings, the power, cooling, security.
Yeah. The whole setup.
Yeah, the whole 9 yards, to clients for power-intensive computational tasks. Think of it as moving from being a producer of a digital commodity,
Like Bitcoin.
right, to becoming a landlord of digital real estate.
That's a fantastic analogy. So how big are they right now, and where exactly do they operate globally?
They are a significant global player. They're operating 15 data centers across 4 countries: Canada, the United States, Paraguay, and Argentina.
Okay, quite spread out.
Yeah. As of Q1 2025, they reported an energized capacity of 461 megawatts and a hash rate of 19.5 exahashes per second.
That's a lot of power.
It is. While they might not be the absolute industry leader in pure hash rate, their recent strategic moves, like acquiring Stronghold Digital Mining in the U.S.
Oh, the Stronghold deal.
and selling their Yguazu facility in Paraguay, clearly show a deliberate consolidation towards North America.
Makes sense.
Specifically the PJM interconnection, that's one of the largest electricity grids in the U.S., and it's critical for their power-intensive HPC AI strategy.
Got it. That's a smart strategic move then, focusing geographically.
Yeah.
So what's their core pitch to the market? What's their unique value proposition?
Their value proposition centers on being global, vertically integrated, meaning they have in-house electrical engineering, installation, and repair centers,
They do it themselves.
which helps them reduce operational costs, minimize downtime, and improve efficiency. The second pillar, which is really important, is their commitment to sustainable energy.
Right, the hydropower.
Primarily environmentally friendly hydroelectric and long-term power contracts. This is smart not just for ESG appeal, but because it's often the cheapest energy source.
Giving them a structural cost advantage.
Exactly.
Let's talk about the bigger picture here. What are the major trends shaping these two very distinct industries that Bitfarms is now operating in? It sounds complex.
It is. They sit at a truly fascinating intersection. The Bitcoin mining industry in 2025 is incredibly professionalized and capital-intensive, hash rates exceeding 500 EHs now.
Wow.
Profitability is razor-thin, dependent on Bitcoin price, which, as you know, has surged past $120,000.
Crazy numbers.
Electricity costs and hardware efficiency. We're talking below 30 joules per terahash now.
So super efficient machines are key.
Absolutely essential. Lower is better, like fuel efficiency for a car. Economies of scale and low-cost power are paramount.
Okay. And the other side, the HPC AI market.
Simultaneously, the high-performance computing, or HPC, and AI infrastructure market is experiencing explosive non-cyclical growth. Demand for compute power is just soaring.
Yeah, we hear about that everywhere.
And the underlying hardware market for the mining ASICs is also projected to grow pretty significantly, a CAGR of 9.67% to over $19.6 billion by 2032.
So growth in both, but different kinds.
Exactly. This dual-track strategy aims to capture the high-beta crypto upside while de-risking with predictable AI demand.
And who are they up against in these very different markets? It sounds like they're fighting battles on two fronts.
They really are. In Bitcoin mining, they compete fiercely with publicly traded giants like Riot Platforms, Marathon Digital, CleanSpark, Hut 8, Core Scientific.
The big players.
Yeah, it's a consolidating industry. And notably, Riot Platforms even attempted a hostile takeover in 2024.
Right, I remember that. And they're still a major shareholder.
They are. We'll get into that later. In HPC-AI, though, they'll face a completely different league of competitors.
Like who?
Established data center REITs like Digital Realty and Equinix, and the major cloud providers AWS, Azure, Google Cloud.
Oh, that's serious competition. Speaking of challenges, what about the regulatory environment? Always tricky in crypto.
It is complex and fragmented. North America, their new focus is generally more permissive, but there's definitely growing scrutiny over energy consumption.
Understandable.
In Argentina, where they still operate, cryptocurrencies aren't legal tender but are widely used. The government is formalizing the sector with new regulations on tax and AML-CTF.
Anti-money laundering.
Right. Anti-money laundering combating the financing of terrorism, including a mandatory registry for virtual asset service providers overseen by their version of the SEC, the CNV.
So more compliance costs and headaches there.
Exactly, which is probably another reason why their pivot to the U.S. makes strategic sense, trying to de-risk from that perspective, too.
It sounds like a monumental undertaking.
Right.
For anyone listening, if they decided today they wanted to get into industrial-scale Bitcoin mining, what kind of hurdles are we talking about? How hard is it really?
It is formidable, honestly. You need massive capital upfront for land, facilities, and thousands of expensive ASIC miners.
Big bucks.
Huge bucks. And then access to low-cost power, often multi-year power purchase agreements, PPAs, in the hundreds of megawatts. That's the most critical and difficult barrier.
The power is everything.
It really is. Plus, you need deep technical and operational expertise, electrical engineering, data center management, 24/7 maintenance. Bitfarms' existing portfolio of data centers and power contracts represents a significant moat.
Something hard for others to copy quickly.
Exactly. It would be incredibly expensive and time-consuming to replicate for a newcomer.
Given those significant barriers to entry we just discussed, the question then becomes, what competitive advantages, if any, does Bitfarms truly possess? Do they have a recognizable brand or any unique strengths?
Well, Bitfarms is recognized within the specialized world of publicly traded crypto miners. They were founded back in 2017, duly listed.
So they have some history.
They do, but that recognition doesn't extend much beyond that niche. Morningstar, for instance, gives them an economic moat rating of none.
Ouch, none.
Yeah. Their brand is tied more to their operational capabilities and that sustainable energy focus rather than, say, pricing power or strong customer loyalty. Their most significant and arguably defensible competitive advantage is actually their cost structure.
Driven by cheap power.
Driven by access to low-cost energy, particularly hydroelectric. Electricity is the biggest operating expense in mining, period, so securing the lowest possible cost is paramount.
Makes sense.
Their vertical integration helps here, too. And that recent acquisition of Stronghold Digital Mining is a major step.
How so?
By gaining direct control over power generation assets in the U.S. PJM market, they insulate themselves somewhat from price volatility. They can
Yeah.
even potentially generate ancillary revenue from energy trading.
Interesting. So controlling the input cost.
Exactly. A classic value investing tenet: control your primary input costs. It's crucial in this business.
So if they lack these traditional moats like network effects, what prevents clients from just jumping ship to a cheaper provider once they're established in the HPC space? Does this put even more pressure on their cost advantage strategy?
That's a great question, and yeah, it's a critical challenge. In their legacy Bitcoin mining, not really much lock-in. Hash rate is largely a commodity.
Easy to switch.
Miners can easily switch pools. In their emerging HPC AI hosting business, there could be some switching costs over time. Maybe if they offer highly specialized integrated services or unique cooling solutions.
But
Initially, yeah, they'll likely compete primarily on price and availability. And that market is known for intense competition.
so that lack of a strong traditional moat
Yeah.
really makes their cost advantages even more critical.
It absolutely does, and it really emphasizes the execution risk they face in this pivot. What makes them truly unique among peers are those existing data centers with secured low-cost power contracts. The Stronghold deal giving them actual power generation facilities in Pennsylvania is particularly unique.
Right. Not many miners own the power plant.
Very few possess that level of vertical integration. Complementing these are their in-house teams for engineering and repair, which means faster deployment and higher operational uptime, theoretically.
Yeah.
They also cite a proprietary data analytics system for best-in-class operational performance. The HPC AI pivot is a direct attempt to leverage this whole combination, low-cost energy assets and operational capabilities, to create a new, more defensible business.
Chapter 2. Management Evaluation. Stewards of a strategic transformation. All right, we've outlined the audacious pivot Bitfarms is attempting. But a strategy is only as good as the people executing it. So let's turn to the management team, who are the individuals steering this ship through such turbulent waters. And what's their track record in navigating challenges of this magnitude?
Well, the leadership team is actually quite new. Average tenure is only about 1 year.
A lot of recent changes then.
Yeah, it reflects a significant overhaul since mid-2024. The CEO, Ben Gagnon, appointed in July 2024, he brings deep operational experience in crypto mining dating back to 2015.
So an operations guy at the top.
Seems like a focus on execution. And a new independent chairman, Brian Howlett, was appointed in August 2024 after a co-founder departed. That suggests a move toward more independent oversight. Their crisis response is being tested in real time, that's for sure.
How so?
First, there was that hostile takeover attempt by Riot Platforms in 2024. The former board resisted with a poison pill defense.
Right, which Riot wasn't happy about.
Not at all. It got pretty intense, though it eventually de-escalated. Second, and this is significant, they're currently facing a class action lawsuit filed just in mid-2025.
Oh, what's that about?
Alleging financial reporting missteps. This followed their own disclosure of a material weakness in internal controls.
Not good.
Specifically related to misclassifying cash flows from digital asset sales dating all the way back to 2021.
Wow, back to 2021.
Yeah. So this whole confluence of events, the takeover attempt, the lawsuit, the material weakness means the new leadership is very much in a prove-it phase.
You mentioned material weakness and restatements for a company trying to raise hundreds of millions and transform its business. How catastrophic is that to investor trust?
Yeah.
Can they really overcome such a fundamental breach of financial integrity?
That's the million-dollar question, isn't it? And it's a huge hurdle. They do maintain a regular cadence of operational updates and quarterly earnings calls.
Okay, so they communicate operationally.
Which suggests commitment to operational transparency. However, their financial reporting credibility has been severely damaged by that December 2024 announcement about restating 2022 and 2023 financials.
Because they misclassified cash flows.
Right. Incorrectly classifying proceeds from digital asset sales as operating cash flow instead of investing cash flow. That, combined with the admitted material weakness and the lawsuit, it points to a major deficiency in financial oversight.
Especially for a company needing market confidence.
Exactly. It's a significant trust deficit they have to work hard to overcome.
Let's shift gears to capital allocation. With this big pivot underway, how are they actually investing their money? Where is it going?
Management's capital allocation strategy has seen a radical shift. Historically, it was all about expanding Bitcoin mining capacity.
Buying more miners.
Constantly. But now they've explicitly stated no plans for large miner purchases in 2025 or 2026.
Really? Okay, big change.
Instead, capital is being redirected to U.S. energy and HPC infrastructure through a bold M&A strategy.
Like the Stronghold deal.
Exactly. In March 2025, they acquired Stronghold Digital Mining, which gave them those power generation assets and a development pipeline in Pennsylvania that's the cornerstone for their U.S. HPC business.
Right.
Concurrently, they sold their 200 milliW Iguazu facility in Paraguay to HIVE Digital.
So selling a mining asset to fund the U.S. infrastructure.
Precisely. Divesting a pure mining asset in a higher risk jurisdiction to fund the U.S. strategy, it's an aggressive reallocation of resources.
And what about returning capital to shareholders? Are we talking dividends, share buybacks, anything like that?
No. Bitfarms does not pay a dividend, has no history of doing so.
Which is pretty typical for this kind of company.
Yeah, typical for a growth stage, unprofitable, capital-intensive company. There's also no evidence of a share buyback program. In fact, their history is characterized by significant and ongoing shareholder dilution.
Through ATM offerings.
Exactly. At the market equity offerings, they raised $314 million that way as of March 26, 2025. This continuous issuance diminishes existing shareholders' stake.
Okay, so dilution is a factor. How effectively are they using the capital they do have then? What does their return on invested capital, the ROIC, tell us?
Look, the bottom line on their return on invested capital, or ROIC, is stark. It's firmly negative. Reported between -12% and -16.5%. This means they are currently generating a loss for every dollar of capital invested.
Wow.
This negative ROIC is a direct result of their unprofitability and capital intensity. From a classic value investing perspective, it's not just a red flag.
It's like a siren going off.
Exactly. It's the fundamental challenge this company must overcome.
So essentially, they're in a race to turn that value destruction into value creation before they run out of runway.
Yeah.
That's a high-risk bet, isn't it?
Absolutely. The entire investment thesis, the whole story here, is predicated on a future dramatic reversal of this metric.
Assuming the pivot works.
Assuming their massive capital expenditures on the Stronghold acquisition and the HPC build-out eventually generate stable, high-margin cash flows, it's a high-risk bet that this new management can transform a value-destroying business into a highly value-accretive one.
Chapter 3. Financial Analysis. A foundation under construction. Now let's dive into the core numbers and really examine Bitfarms' financial health. What's their current market capitalization? Where do they sit?
As of July 17, 2025, Bitfarms has a market cap of approximately $559.18 million.
Okay, so firmly in the small cap segment.
Definitely small cap, which, often means higher growth potential, but also comes with greater price volatility and risk.
For sure. And smaller than their big competitors.
Considerably smaller than Marathon Digital and Riot Platforms, yeah.
How have their revenues looked over the past 5 years? Has it been a smooth climb or more of a roller coaster?
Oh, definitely a roller coaster. Their revenue history clearly shows their dependence on the volatile crypto market.
Big swings.
Dramatic fluctuations. $35 million in 2020 surged to $169 million in the 2021 crypto bull run.
Right.
Then declined to $142 million in 2022 during the crypto winter, stagnated at $146 million in 2023, and then resumed growth to $193 million in 2024.
Okay, so up and down with Bitcoin.
Pretty much. The latest quarter, Q1 2025, showed $67 million, a 33% year-over-year increase, driven by Bitcoin's recovery and their expanded hash rate, but it really underscores that their top-line performance has largely been a function of external market forces.
Looking beyond the top-line revenue, what does their actual profitability look like? Are they turning these massive operations into actual earnings?
That's where the picture gets much more challenging. Their margins are volatile and often deeply negative.
Right.
The gross mining margin, that's core mining profitability before overhead, stood at 43% in Q1 2025.
Which sounds okay,
But it was a sharp decline from 63% in Q1 2024, despite a substantial rise in Bitcoin's price during that period.
So margins are shrinking even with higher BTC prices.
Yeah, this compression indicates that rising electricity costs and increasing mining difficulty are severely offsetting the benefits of higher Bitcoin prices.
Tough environment.
Very tough. On a comprehensive basis, the company is unprofitable. Negative operating margin of -41.2%, negative net profit margin of -40.1% for the trailing 12 months.
Consistently in the red then.
Deeply and consistently in the red.
Given that, are they generating any real cash from operations? Is cash coming in or burning out?
This is a critical area, and Bitfarms has consistently struggled here. They are in a state of significant cash burn.
How bad?
Cash flow from operations was negative $127.85 million for the trailing 12 months.
Wow.
Q1 2025 continued this trend at negative $18.58 million. In fact, they've only produced positive cash from operations in 1 out of the last 5 years.
Only 1 year.
Only one. Consequently, free cash flow is also persistently negative. This chronic inability to self-fund explains their continuous need to tap capital markets.
Debt and those dilutive equity offerings.
Exactly. Which, for you as a potential shareholder, is a major ongoing risk.
So walk us through their earnings consistency over the past 5 years. Sounds like there isn't much. And give us a snapshot of their assets and liabilities as they've shifted.
You're right. Their earnings history shows a complete lack of consistency. It's dominated by losses, entirely beholden to crypto cycles. They did report a net profit of $22 million back in 2021.
The bull run peak.
Right. But then substantial annual losses. Negative $176 million in 2022, negative $109 million in 2023, and negative $54 million in 2024. Q1 2025 saw another $36 million net loss. Assets $454 million, liabilities $62 million, negative cash flow from ops and negative $141 million.
Okay.
Go back to 2021, that bull run. Revenue $169 million, net income $22 million, assets $540 million, liabilities $110 million, and positive cash flow from ops of $103 million.
Huge difference.
Massive. And then compare that to 2020. Revenue just $35 million, net loss $16 million, assets $52 million, liabilities $30 million, negative cash flow from ops, negative $2.33 million.
What these numbers truly reveal is a company caught in a financial maelstrom, perpetually dependent on external capital, not organic cash flow, to fuel its very survival, let alone its ambitious pivot. This truly highlights the volatility.
Given all of that cash burn and inconsistency, what's their debt situation like, and how is it changing, especially with this new pivot and the Stronghold acquisition?
Well, historically, their balance sheet was actually relatively low leverage.
Really?
Yeah, their debt-to-equity ratio was pretty low, ranging from 0.4% to 3.86% by the end of 2024. Total debt was only a modest $26.24 million at the end of 2023. That conservative approach was a strength.
Was. Yeah.
Because their capital structure is about to radically transform. In Q2 2025, they secured that new private debt facility for up to $300 million with Macquarie Group.
The big one to fund the HPC build-out.
Exactly. Drawing on this will dramatically increase leverage and financial risk.
How so?
Well, while it provides growth capital without immediate share dilution, which is good,
Yeah.
it introduces substantial interest payments and significantly reduces their margin for error. If that HPC venture doesn't generate robust cash flows reasonably quickly,
Then the debt becomes a big problem.
their financial stability could be severely compromised. It's a very significant shift in their risk profile.
Are there any positive liquidity signals amidst all this cash burn and new debt? Any bright spots?
Yes, actually. Their short-term liquidity looks healthy. Their current ratio stands at 2.64.
Which is good.
Yeah, generally considered strong. Anything above 2.0 is pretty solid. This indicates they have sufficient liquid assets to cover their short-term obligations, which does reduce some near-term solvency risk.
Okay, so they can pay their immediate bills. And what about dividends? Any hope for shareholder payouts for our listeners?
No, Bitfarms does not pay a dividend. No history of doing so.
And likely won't anytime soon.
As a company in a high-growth, high-investment phase that isn't currently profitable, all available capital is being reinvested. There should be zero expectation of a dividend in the foreseeable future.
With all these losses, can we even use traditional valuation metrics like price to earnings or PE to assess them, or is that just not meaningful right now?
You're exactly right. The PE ratio is not meaningful for Bitfarms or its direct competitors right now.
Because they have negative earnings.
Exactly. Because of consistent net losses, they have negative earnings per share, making the PE ratio mathematically undefined or just nonsensical. This is a sector-wide issue.
Right.
They only briefly sustained a positive PE during the absolute peak of the 2021 crypto bull market. You have to look at other metrics.
Like what?
Their price to sales, PS ratio is 2.28. Their price to book, PB ratio is 0.86.
PB below 1. Sometimes that signals value.
Sometimes, yeah. A PB below 1.0 can sometimes signal undervaluation. But for a company with volatile asset values like crypto miners and a business in complete transition.
Needs to be taken with a huge grain of salt.
Exactly. Needs to be interpreted with extreme caution.
So, if PE is out, how do we think about valuing them then? Can you explain the concept of a discounted cash flow DCF model for a company like this, especially with all these moving parts and uncertainties?
Sure. A DCF analysis is a fundamental way to estimate intrinsic value. The idea is you project future cash flows,
What you think the company will earn.
Right. And then you discount those future cash flows back to their present value today. The core idea is that a company's worth is the sum of all the cash it can generate over its lifetime.
Makes sense in theory.
But for Bitfarms, conducting a DCF is exceptionally challenging
Why?
because of the extreme uncertainty around its two future revenue streams: the volatile Bitcoin mining proceeds and the entirely unproven HPC AI income. You're dealing with a lot of if-then scenarios and speculative assumptions.
Given that complexity and all those if-thens, what's the estimated value range from an educational DCF model for Bitfarms, and what are the key assumptions driving it to be so wide?
Okay, so our educational DCF model, and I stress educational and highly uncertain, yields an exceptionally wide estimated intrinsic value range of 75 cents to $2.25 per share.
Wow, that's a huge range, 75 to $2.25.
Exactly. This broad range directly highlights the model's high sensitivity to those key assumptions, which are, by necessity, quite speculative. For revenue projections, for example, we need a two-stage dual-stream model.
One for mining, one for AI.
Right. Bitcoin mining revenue is based on their hash rate targets, conservative assumptions about network difficulty growth, and some kind of long-term cyclical Bitcoin price.
Which is anyone's guess.
Pretty much.
Yeah.
For HPC AI revenue, this is the most speculative part. It's modeled on a phased build-out of their U.S. data center sites.
Using the stronghold assets.
Yes, assuming a certain percentage of their 1.4 gigawatt development pipeline comes online over the next 5 to 7 years, with revenue per megawatt derived from current market rates for HPC hosting.
Yeah.
Very hypothetical.
And the discount rate.
The discount rate, or weighted average cost of capital, WACC, has to be set very high. We used a range of 15% to 20%.
Why so high?
To properly reflect the multitude of risks: the extreme volatility of Bitcoin, the significant execution risk of the pivot, the uncertain regulatory landscape, and the stock's high beta, its market sensitivity.
Makes sense. Lots of risk.
And finally, a conservative terminal growth rate of 2.0% to 2.5% is applied for cash flows beyond the explicit forecast period, reflecting long-term nominal global GDP growth once the business theoretically matures.
If it ever gets there.
Exactly. Big if.
Part 2. Navigating the landscape. Chapter 4. Market sentiment. Weighing hype against headwinds. Let's transition from the raw fundamentals to how the market is actually feeling about Bitfarms right now. What do Wall Street analysts think? What are their price targets? Are they bullish, bearish, or somewhere in between?
Well, this is fascinating. There's a profound disconnect between analyst sentiment and the company's current financial performance.
Oh, how so?
The consensus among covering analysts is overwhelmingly bullish.
Really? Bullish?
Yeah. Some sources show 60% strong buy and 40% buy, while others indicate a unanimous 100% buy rating.
Wow. Despite the losses in cash burn.
Exactly. This bullishness is reflected in their average 12-month price targets, which range from $3.42 to as high as $4.84.
That's like triple the current price.
More than double or triple the current stock price of $1.08. It's clear analysts are looking through the current operational losses,
Focusing on the future potential.
heavily weighting their valuations on the successful execution of the HPC AI pivot, and importantly, a sustained high Bitcoin price.
So they're really betting on the future story. What about the general media tone, and how has recent news, both good and bad, impacted the stock price?
Oh, Bitfarms stock price is highly reactive to news, very sensitive.
For example?
Positive catalysts like the announcement of the strategic pivot to HPC AI back in Q1 2025 sent the stock soaring by nearly 20% in a single day.
Big jump.
Conversely, negative news, such as that class action lawsuit we mentioned in June 2025, caused it to drop over 5%. And ongoing news about their competitor, Riot Platforms, trimming its large stake, has also been a source of persistent volatility.
The Riot selling pressure.
Yeah. So the general media tone is definitely a tug of war between this compelling growth story and a list of significant tangible risks.
What do market indicators like short interest and moving averages tell us about how much skepticism is out there among investors? Are people betting against it?
Yes, a segment of the market remains deeply skeptical. This is evidenced by significant short interest,
How high is it?
standing at 8.45% of the public float. That's about 41.84 million shares being sold short.
So a decent number of bears.
Indicates a meaningful number of participants are actively betting the stock price will decline, likely due to that high execution risk or the ongoing unprofitability. The days to cover ratio is 4.01 days,
Meaning
meaning it would take about 4 days of average trading volume for all the short sellers to buy back their shares. This suggests a potential short squeeze could happen if a strong positive catalyst emerges.
okay. And the technicals, moving averages.
Technical indicators paint a more bearish picture right now. The stock is currently trading below its 50-day simple moving average.
Bearish short-term signal.
Right. And it's also significantly below its 200-day simple moving average, which stands at $1.43.
Indicating a bearish long-term trend.
A strong bearish long-term trend. So this creates a stark contradiction. You have fundamental analysts who were super optimistic.
Seeing the long-term potential.
But the market action, the technicals, suggest caution and a downtrend across multiple timeframes.
Interesting conflict there. Chapter 5. Ownership structure. The forces at play. Who actually owns Bitfarms? What does the ownership structure tell us about the company dynamics and potential future moves?
Well, Bitfarms has a notable but not dominant institutional presence.
Okay, what percentage?
About 21.3% of shares are held by 191 institutional owners. That leaves a significant portion in retail hands.
So a lot of individual investors.
Seems so. Top institutional holders include firms specializing in digital assets and ETFs names like MMC App International, Van Eck Associates, Invesco.
Makes sense. Crypto-focused funds.
Exactly. And the presence of ETFs like the Valkyrie Bitcoin Miners ETF and the Schwab Crypto Thematic ETF underscores that much of this ownership is passive.
Just tracking the theme?
Right, driven by the crypto theme itself. Recent trends show institutional shares actually decreasing by about 8.33%.
Institutions selling off a bit.
Could signal caution, or maybe just profit-taking? Hard to say definitively.
What about insider holdings, particularly any large influential players? We heard about Riot still being involved.
Direct insider ownership by the executive team, like CEO Ben Gagnon's 0.079%, appears minimal.
Very small stake for the CEO.
Yeah. However, the most significant insider activity, if you can call it that, comes from Riot Platforms,
The former hostile bidder.
who still holds more than 5% of the company's stock. After its failed takeover bid, Riot has been a consistent seller of Bitfarms shares,
actively selling.
systematically reducing its stake. It went from over 14% in June 2025 down to 9.85% as of July 16, 2025.
Wow, that's quite a reduction. How does Riot explain that?
Riot frames this as a broader portfolio reassessment.
Yeah.
But regardless of the stated reason, this persistent selling pressure is an undeniable market reality influencing the stock price.
So Riot, a former would-be acquirer, is now actively selling its stake. How concentrated is the ownership overall? And what are the implications of that kind of dynamic with a large seller in the market?
The ownership structure is becoming more diffuse, largely because of Riot selling. For a while, Riot Platforms was the most significant concentrated owner.
Which created uncertainty.
Right, created a dynamic where a single, potentially hostile shareholder held significant sway. But with Riot's systematic selling and its stake now falling below 10%, this concentration is diminishing.
Is that good or bad?
It's kind of a double-edged sword.
Yeah.
In the long term, a more diversified shareholder base can bring stability.
True.
However, in the short term, this deconcentration process itself is creating a major headwind for the stock. The Riot overhang is transforming from a speculative catalyst like maybe they'll bid again into a consistent source of supply hitting the market.
Making it harder for the price to go up.
Exactly.
Chapter 6, Risk Assessment. Navigating a minefield of uncertainty. Let's pull back and consider the full picture of Bitfarms' strengths, weaknesses, opportunities, and threats. The classic SWOT analysis. What are its core internal competencies? What are they genuinely good at?
Yeah. Okay, strengths. Their vertical integration is definitely one, having in-house electrical engineering, construction, repair. That helps with cost control and uptime.
Right.
Key strength is their low-cost power strategy, especially through hydroelectric and those long-term power contracts. That's the most critical driver of profitability in mining.
Power, power, power.
Always. They also benefit from geographic diversification initially, and now a more strategic U.S. focus, which offers resilience against localized issues. And just their general operational experience and scale as a really public mining company creates a barrier to entry.
Okay, those are the pluses.
No.
What about their internal limitations, their weaknesses? What truly holds them back?
The weaknesses are significant. Persistent on profitability and that negative return on invested capital we discussed.
Not making money.
Right. A chronic cash burn requiring constant external financing, and the resulting continuous shareholder dilution through equity offerings.
Burns cash, sells stock.
That's the cycle. Then there's the acknowledged deficient internal controls and forced financial restatements.
It's a trust issue.
Raises serious questions about oversight and trust. and crucially, their relative inexperience in the new HPC AI ventures.
Huge execution risk there.
Significant execution risk in a highly complex and competitive industry where they are basically the new kid on the block.
On the flip side, what are the biggest opportunities for future growth and potential? What could truly propel them forward if things go right?
The primary opportunity is obvious. Successfully leverage their infrastructure for the explosive growth in HPC AI demand.
Ride the AI wave.
Exactly. That offers a path to more stable, high-margin, and secular growth, potentially delinking them from crypto volatility.
That's the dream.
That's the bull case dream. They also still retain Bitcoin price upside as a major miner and holder. Don't forget that.
Still have crypto exposure.
And with the Stronghold acquisition, there's an interesting opportunity for energy market monetization,
How?
creating new revenue streams through energy trading and demand response programs in that U.S. PJM market. That's a unique angle for a company like this.
Okay. And what are the general external challenges or threats they face, the things largely outside their control?
Well, number one is the threat of extreme Bitcoin price volatility, completely outside their control.
Always the big risk.
Always. There's the relentless rise in mining difficulty, forcing constant investment in new hardware just to maintain the same level of rewards.
Running faster just to stay in place.
Pretty much. They face intense competition from larger, better capitalized rivals in both mining and HPC. And there are ongoing legal and regulatory headwinds, including that class action lawsuit and just broader crypto regulatory uncertainty.
Lots of external pressures. Beyond the industry specifics, how do broader macroeconomic factors like inflation and interest rates affect a company like Bitfarms? Do they feel those shifts heavily?
Oh, absolutely they do. The macroeconomic environment presents a significant threat right now.
Especially with that new debt.
Exactly. Persistently high interest rates directly increase their cost of capital, making their ambitious expansion plans more expensive, especially with that new $300 million debt facility from Macquarie.
Higher interest payments.
Higher interest expenses, adding pressure to their already negative cash flows. Inflation can also drive up costs for construction labor and materials for building out those data centers.
Potentially leading to delays and budget overruns.
Correct. It's a tough macro backdrop for a capital-intensive expansion.
Okay, here's where it gets really interesting. Our sources mention a specific geopolitical factor, the 2025 U.S.-imposed tariffs. How do these tariffs on imported goods impact Bitfarms, and what does it reveal about their strategic pivot? This sounds key.
This is a crucial point, yeah. And it actually, in a way, beautifully illustrates the strategic intelligence, or perhaps necessity, behind their pivot.
How so?
New U.S. tariffs, including a 25% duty on Chinese-made goods and potentially even higher rates from other hardware manufacturing hubs.
Where most mining rigs come from.
Exactly. They directly and significantly increase the capital expenditure required for any U.S.-based miner to expand or upgrade its fleet, because most efficient ASICs come from these regions.
So a direct hit to U.S. mining expansion costs.
Right. This poses a direct threat to Bitfarms' U.S.-centric growth strategy if they were focused on buying new miners.
But they said they aren't buying miners.
Exactly. What's fascinating here is that this threat powerfully validates management's strategic pivot. Their explicit decision to halt large miner purchases in 2025 or 2026, and instead focus capital on building infrastructure for HPC clients,
Who bring their own servers.
who typically provide their own specialized servers, means they are potentially savvy enough to sidestep the worst impacts of these tariffs on CapEx.
Ah, so the pivot helps them avoid the tariff pain on hardware.
It makes the successful execution of the pivot to an infrastructure hosting model not just an opportunity for growth, but maybe even a strategic imperative for survival in this new tariff environment. It looks quite smart in retrospect, or perhaps prescient.
Chapter 7, Conclusion. So what does this all mean? Let's bring it all together. What are the key bullish points, the bull case for Bitfarms? What's the optimistic outlook here?
Okay, the bull case. It's a compelling but definitely high-risk narrative of transformation.
The turnaround story.
Right. It believes management can successfully pivot from being a volatile Bitcoin miner to becoming a stable, high-margin digital infrastructure provider for the AI era.
Leveraging their core skills.
Leveraging their core competency building and operating large-scale, low-cost energy infrastructure to tap into the powerful secular growth of AI. This has the potential to de-link their financial performance from crypto volatility and create predictable cash flows.
That's the whole.
Key pillars supporting this are the strategic acquisition of power-generating assets in the U.S. through the Stronghold deal.
The physical foundation.
Right. And securing that $300 million debt facility from Macquarie Group, which provides both capital and arguably crucial third-party validation.
A big institution betting on them.
Exactly. If this transformation succeeds, the current share price, which clearly reflects market skepticism,
At $1 at 8.
could be a deep value entry point into what could eventually become a premier North American energy and compute company.
Yeah.
That's the blue sky scenario.
And what about the bear case? What are the key bearish points that could send this company down that road to ruin we mentioned at the start?
The bear case is grounded firmly in the company's current financial reality.
The ugly numbers.
It's unprofitable, consistently burns cash, and has a history of shareholder dilution. They are pivoting into a highly complex and competitive HPC AI data center market where they have no established expertise or track record.
Huge execution risk again.
Massive execution risk. This is compounded by those serious governance and financial reporting concerns, the material weaknesses, forced restatements, the ongoing class action lawsuit.
Trust and oversight issues.
Yeah. And the substantial new debt load from the Macquarie facility adds a significant layer of financial risk. If that HPC strategy fails to generate robust cash flows quickly,
The debt could sink them.
it could severely jeopardize their solvency. The bear case essentially argues that the combination of operational challenges, financial instability, and execution risk is simply too high a hurdle to overcome.
We used an educational discounted cash flow model to give us an intrinsic value range earlier. What did that tell us again, and where does Bitfarms' current share price fit into that broad spectrum?
Right, our educational DCF analysis, again, interpret with extreme caution due to the high uncertainty yielded that exceptionally wide intrinsic value range of 75 cents to $2.25 per share.
$1.50 spread, huge range.
Huge. This broad spectrum is a direct reflection of the valuation's sensitivity to highly speculative inputs, like future Bitcoin prices and the speed and profitability of the HPC-AI business rollout. As of July 17, 2025, Bitfarms' current share price of $1.08.
Where does that sit?
It's positioned within the lower half of this estimated intrinsic value range.
Okay.
This market pricing suggests that investors are acknowledging the potential upside of the company's transformation.
They see the story.
But they are applying a heavy discount for the substantial execution, financial, and regulatory risks involved. The current price reflects neither the unbridled optimism of the bull case nor the complete pessimism of the bear case. It's somewhere in between, pricing in a lot of risk.
So what's our final thought for you, our listener? An investment in Bitfarms at this juncture isn't really a traditional value play, is it?
Not at all. Not based on current earnings or a stable business model.
Instead, it represents a high-risk, high-reward, almost venture capital-style bet on the ability of a new management team to engineer a complete and complex business transformation.
And do it in the face of numerous headwinds.
Right. The outcome, it seems, will depend less on the daily price of Bitcoin, surprisingly, and more on management's ability to actually execute their ambitious vision over the next several years.
It truly is a fascinating balancing act between an old, volatile industry and a new, explosive one.
Absolutely. Well, if you're gaining these kinds of deep insights from our work, make sure to like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, definitely helps us out.
And did you know that for just €4.99 a month, members get priority deep dives on specific tickers? Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access.
That's a lot of companies.
It is. And if you just want a one-off deep dive on a company that you are interested in, simply drop us a super thanks. We appreciate the support.
And a final reminder from us. This analysis was generated by an AI system for educational purposes only.
That's right.
It should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Do your own homework. Thanks for joining us on the deep dive.